Hey there, ever stared at the national debt ticker just climbing nonstop and thought, why can't we just print a ton of money and make it all go away? I mean, we're the government, right? Just fire up the printing presses, hand out the cash, and boom, problem solved. But if it were really that simple, don't you think we'd have done it already? Let's unpack this idea that seems so logical on the surface, but has proven to be one of the fastest ways to ruin an economy. Because yes, technically a country can print more money, but no, that doesn't mean it should. In fact, the real cost of doing so can be far worse than the debt itself. Now, when people talk about printing money, they imagine stacks of bills rolling off machines. But most money today isn't even physical, it's digital. Central banks like the Federal Reserve increase the money supply by buying government bonds. That's how they inject money into the economy. It's not about ink and paper, it's about numbers on a screen. And that's where the problems begin. Every time new money is added without a matching increase in goods or services, it dilutes the value of existing money. That's inflation, and when it spirals, it becomes hyperinflation. That's when prices double in days or hours. And yes, this has happened many times. Look at Venezuela. In 2018, the government printed money to cover spending. Inflation hit over 130,000% in 1 year. People brought backpacks of cash just to buy food. The bolivar collapsed. People switched to US dollars or even crypto. Zimbabwe did the same. By 2008, inflation reached 79.6 billion%. They printed a $100 trillion note. It couldn't even buy lunch. Eventually, the currency had to be abandoned. So what about the US? Couldn't a developed nation handle it better? During the 2020 COVID crisis, the Fed injected over $3 trillion into the system. That wasn't direct printing, but it flooded the economy with liquidity. By 2022, inflation hit 9.1%, the highest in 4 decades. That happened without printing to pay off debt. Imagine if we did that too. We'd be begging for 9% inflation again. And here's what most people don't realize. Over 70% of US government debt is owned by Americans. Pension funds, Social Security, insurance companies, mutual funds all rely on treasuries. Printing money to pay them back would mean devaluing their own savings. Another 30% is held by foreign governments and institutions. Japan owns over $1.1 trillion, and China holds around $775 billion. If we printed money to pay them back, we'd destroy the value of their investments. They'd stop trusting us. They'd stop buying our debt. Treasury yields would spike. Borrowing would become impossible or insanely expensive. In short, printing money doesn't erase debt. It erases trust. And when trust in a currency goes, everything else collapses with it. So why does the government borrow in the first place? Should we just live within our means? In theory, yes. In reality, governments run deficits all the time. In 2024, the US had a $1.8 trillion budget deficit. Tax revenue simply wasn't enough to cover expenses like defense, healthcare, and infrastructure. So they borrowed. Cutting services would spark outrage. Raising taxes is even more unpopular. Borrowing is often the path of least resistance. But not all borrowing is bad. Taking on debt to fund highways, schools, and technology is an investment. It boosts productivity and can grow the economy. That growth can eventually help reduce the debt burden. The problem starts when borrowing has no return, when it's used for short-term spending or just to stay afloat. That's when things spiral. Some suggest canceling the debt we owe ourselves, like the $7.3 trillion owed to Social Security and other government accounts. But canceling it would gut those programs. Millions of retirees rely on them. It would also destroy global market trust. Investors would pull out, credit ratings would plummet, interest rates would skyrocket. Money is more than paper. It's trust. It's a promise that your cash has value. Break that trust, and no printing press can fix the consequences. Let's imagine the US does it anyway, prints $34 trillion and pays off its debt. What happens next? People suddenly have more cash. They start spending, demand surges, but supply can't keep up. Prices explode, inflation skyrockets, the dollar drops in value. The Fed hikes interest rates aggressively, maybe to 10% or more, to try to cool the chaos. Loans become expensive, businesses cut back, people lose jobs, the economy crashes. It's not just theory, it's a repeatable pattern. Every country that's tried it ends up with the same outcome: crisis. Even during the pandemic, the Fed's balance sheet ballooned from $4 trillion to over $9 trillion. That wasn't to pay debt, it was to keep credit markets stable. Still, that alone was enough to trigger runaway inflation by 2022. That's why in 2025, the Fed is now shrinking its balance sheet through quantitative tightening, because even temporary money has long-term consequences. And let's not forget what inflation really does to everyday people. Wages don't rise as fast as prices. Savings lose value. Essentials like food, gas, and rent become unaffordable for millions. Retirees on fixed incomes get hit the hardest. Inflation is often called a hidden tax because it quietly reduces your purchasing power without changing the amount in your bank account. Now, think about mortgage rates. In early 2022, the average 30-year mortgage rate was around 3%. After inflation spiked, those rates doubled. That means monthly payments soared, locking millions out of home ownership. All of that came from inflation, and inflation came in part from excessive money in the system. And it's not just households. Businesses also suffer. When inflation is high and money loses value quickly, companies struggle to plan, invest, or even price their products accurately. The uncertainty can freeze expansion, delay hiring, and shrink profits. That ripples through the entire economy, slowing down innovation and killing long-term growth. All of this because the value of money got messed with. So why does the idea of printing money keep coming up? Because it sounds easy. It feels like a shortcut. But shortcuts in economics often lead off a cliff. The actual solution? Grow the economy. When GDP grows faster than debt, the debt becomes easier to manage. If we boost productivity, invest smartly, reduce waste, and improve tax efficiency, debt levels can fall as a percentage of GDP, even if the total number stays high. But that takes time and discipline and real work. No magic fix, no money printer miracles. So the next time you hear someone ask, "Why can't we just print more money and pay off all our debts?" you'll know why. It's not just bad policy, it's financial self-destruction. If you want a deep dive into inflation or what really happens when a country defaults, hit the comments and let me know. Like the video, subscribe if you haven't already, and congrats. You officially know more about modern economics than half of Twitter.